Hello, this is Coach Mike from WinningStockCoach.com. I'm going to go over the weekly market overview. Starting out here with the SPX, the S&P 500 index. Last week we talked about the necessity of holding above the swing point line. We had seen, the Friday before, kind of come down, still close above it. Monday gave us the up move. Now we also talked last week and in previous videos when we've seen this type of pattern that for the past 6-9 months, about every 3 months we get the type of pullback. We were watching for that 1908.47. Had talked about it for 3 or 4 weeks before the drop hit. It got there, we took the bounce off of it. We expected about a 3-week run up, and that's what we had got to this point. And at that point in time we talked about the consistency the market had given us, knowing that once it got to this point, even though we still believed it would make a general upward move, we'd start to see more of a consolidation and some more difficult trading. For members of the coaches roster, when we were down here off of this bounce, I stressed to you the importance of different types of trading. You shouldn't limit yourself to only being a long-term investor or only being a day trader. That's really you being your worst enemy. And what you saw in the S&P 500 is it gave us the opportunity for a mix of longer-term trades and individual swing trades that we expected to hold 3 to 4 weeks, and a lot of those we have since made our exits on after phenomenal gains for the shorter term swings. Now we're to that point where we could get a little bit of rocky behavior. We've seen that over the past year as we made runs up and we start to get still that general upwards direction, but you might be up 2 or 3 days and down for 2, and up 3 days and down for 4, and up 5 days and down for 3. A general consolidation pattern, but still upwards as far as the overall movement. We've seen that each one of the market dips really since the government shut down October of last year. So this past week, what did we see? Exactly that. We had a nice day Monday, blah type of day on Tuesday. Wednesday and Thursday, little doji candles to the downside. Friday, decent day. We'll have to see where futures open us up tomorrow. Futures are being traded since yesterday evening for U.S. markets, even though they're closed today, which is Labor Day, September 1st. But futures are trading just pretty well flat, but a little bit to the downside at this point in time. I see the S&P 500 under 2,000 at 1999.60 right now. So, I'm not saying, oh my gosh, it's going to crash. I'm saying we're in that time where rather than looking at the longer term things now, we have to focus on momentum trading, shorter term swings, and this is a good time where you find a lot of day trading abilities. It's foolish on a big market drop like what we saw to day trade the bounce. You're selling yourself short on profits. But in that consolidation, your shorter term trading becomes a little better, because it is quite possible that you might run up for a day or two and a couple days after that be right back or just really close to where you started. So let's use all of the tools we have, all the weapons in our own personal arsenal for our war against Wall Street. Let's use all of those tools and make the best trades possible. Right now, longer term entries, we make those on the big dips. Shorter term entries, that's what we're looking for now. Using your 60-minute charts, you'll find a lot of high probability trades still, as opposed to a daily chart, which you're going to see, wow, this thing is, the indices have run so much since the last bottom. Even though they could continue to squeak out more gains, it's very easy to look at it and say, I might have missed most of the move. It's very easy to look and say that. Now, as we develop a consolidation range like we did over a couple months down here, we can play the range breaks and have a healthier support level. Once that's established, we can absolutely do that. But for right now, let's concentrate back from those longer term entries that we were taking a few weeks ago and even the longer swings, those 3 to 6 week long planned swings, into the shorter swings and momentum type trades, and even some of the day trading for those of you that enjoy the day trading in this upcoming week. Remember too, it's a short week. It's a holiday week. Short weeks are typically low volume. The only thing different with the Labor Day week is it's also the unofficial end of summer, and generally after Labor Day we start to see the return of some volume. That doesn't mean on Tuesday you're going to see 20 times the average daily volume that you saw all summer long, but you could start seeing that volume on Tuesday. Me personally, I'm one that likes to react to what I see. I plan for what could happen, and then I'll react to when it happens. And I don't try to convince myself that something will go up or will go down. I simply trade what it does. And what I'm personally expecting, even though I'm very versatile and able to change quickly, is that this week, due to the holiday week, might still be a little bit slower, and we'll see that volume return afterwards. Or that this week, even though the volume may be a little slower, they might eke out the rest of the run to the target area we were talking about, and that volume could be in a market pullback that sets up for the next run. Even though it hasn't been the 3-month long period, we saw that last year. We had a quick run up in early September, the fall into early October, and then we started that every 3-month type sequence where we went up for 2-3 weeks, consolidated, did consolidation range breaks, consolidation range break, pullback. 2 to 3 week up, consolidation, consolidation, range break, consolidation, pullback. So that's kind of what I expect would happen, but at the same time, I don't trade on what I expect, I trade on what I see, and I'll be willing to be versatile with that. So let's concentrate a little more on the shorter term of the trades right now, the shorter term trade planning tools that we use, and still be able to find some real quality trades in the upcoming week. Moving over now to the DJI, the Dow Jones Industrial Average. Again, the bounce off our trend line we had talked about and prepared for into that. I think the upside potential is very limited, even though I still think it probably gets there into the 17,200s. You have to look at a chart like this and say, okay, even though it could get there, the risk definitely outweighs the reward. Quite literally, you have to look at things and say, yep, I missed that. Even though I didn't miss it, I made the trades I wanted to trade. For potential new trades, you might have to let it squeak out that last little bit before you trade to the downside. Now, the advantage you have with the Dow Jones Industrial Average right now is it made the double top and pulled back from it. Further pullback, you could look for short opportunities among the 30 DJI charts, with this double top line being your resistance or stop out point. But also, should it break it, though the upside potential I do believe is limited, you might see some momentum trades in those DJI charts created should that break, and you have a support level that you can use from that point moving forward. Now over to the Russell 2000, our small cap index. This is the one that's not really made that full move that I expected. We've got the double top up in here, essentially, real close to the exact price of a double top, and we've really only completed half of the projected move that I think it possesses the ability to do. And I really think we got to watch that 1172.87. Right now, I would say that could serve as our support level, and a fall back below it would serve as resistance for a short trade. Due to the higher low being made on the last bounce, I would not be surprised to see a higher high, because plain and simple, that's just a general assumption that you can be right 85 to 90% of the time by making. so it's one that is worth making. But as we can reestablish better support points along the way, we can have a better risk to reward ratio and better risk management strategy on the trades. I think right now, as far as the upside potential goes, a lot of your small cap stocks might be the place to look should the market continue strong. If the markets continue strong, the small cap stocks, and people misconstrue what a small cap stock is all the time. People think a small cap stock is a cheap stock. Zillow, ticker symbol Z, is a small cap stock. It's one of the Russell 2000 stocks. Yelp, Y-E-L-P, is a small cap stock. There are cheap stocks that aren't small cap. The market capitalization, and whether it's considered a micro, a mini, a small, a medium, a large, or a mega, is determined by the value of the price of shares times how many shares there are. And if that price is between $300 million and $2 billion, it is considered a small cap stock. So I'd be watching your Russell 2000 list. There's a lot of biotechs in that Russell 2000 list that have already made some runs, and a lot of the small cap ones that are kind of setting up where they look like they could run. So it does give me an interest in small caps for this upcoming week. We'll have to see if the market starts out strong, and if it starts out strong, take those chances on an index that has a larger amount of room to run. And finally, over to our COMP chart. This is our Nasdaq Composite chart. We talked a couple weeks ago. We waited for the momentum trade on the break of this line. The momentum trades happened. You saw longs that we had. Apple took off. Twitter did phenomenal. Twitter made a heck of a run for our long position in Twitter. Amazon's done good. It's made up nearly all of that earnings gap down. Netflix we saw with good runs. Several stocks in the Nasdaq Composite with good runs on this momentum breakout. We waited patiently. We saw some lead-in trades come before it, and then we're able to acknowledge how it had hit resistance and pulled back from, and had planned for if we got the continued pullback from resistance, we would exit trades. But if we got the breakout for momentum, we would not just hold what we had but enter more, and that's what we saw over just the past 2 weeks for Nasdaq stocks. Now, could this continue on? Yes. Would I be chasing things that have already made big moves, seeing what the chart has already done? No, I wouldn't. I would be expecting that even if it did make some bit of a move up, that you have to be able to look at a chart like this and say, I missed it. But no stock goes straight up or straight down. The indexes don't go straight up or straight down. To think they do is very foolish. Any stock that just makes one run up, falls down, and never runs again, it's not worth trading anyway, because those are typically your OTC pump and dump stocks. So when you miss a run, go with the higher probability opportunity that you'll make money from the time you enter it, and that opportunity is going to be when it makes a pullback. This is Coach Mike from winningstockcoach.com, wishing you the best of luck in your upcoming week of trading, and God bless.